Hello, Marc Ostwald from ADM Investor Services International with some thoughts on how things look as we start into Q4, above all in terms of US dollar interest rates and how they may impact broader asset markets. So, first of all, let's start with this week and the dramatic shift that we've seen in expectations for the October 30th FOMC meeting, which at the beginning of the week we were only pricing in about a 40% chance of a rate cut, and this has moved all the way up to 85% yesterday, thanks largely to the dismal run of PMIs that we've had, above all the ISM readings out of the United States, and a somewhat downbeat ADP employment index, which makes obviously today's payrolls number before this recording is made before that. But nevertheless, it really does show that we've had quite some volatility in rate expectations. And that in itself is something which we should all be mindful of, because if we get that sort of choppiness, it will be reflected also in money rates. So let's move swiftly on. And I think the next chart is an important one. Yes, we've had a great run in terms of bond markets around the world this year. US Treasury yields have come down from that 310, 320 level. This time last year, we're down at the lows now at 152. Bund yields have come from about 0.6 to minus 0.6. The question now is, as we go into Q4, if you've been riding that bond market rally, above all in the G7 markets, really how much further downside do you think that there is, particularly when one looks at the performance over the last 6 to 8 weeks, which has actually been sideways? I think this is an important point because it does probably point to people's strategies in terms of government bond markets as not being overly aggressive, even if we do start to price in more in the way of Fed rate cuts. So let us then move on to something else which I think is important as we go into Q4. Namely, this is the US dollar FRA OIS spread, measure of money market stress. Typically, it does rise at this time of the year. As one can see on the left-hand side of that chart, it rises into the year. But this year, we're already at the beginning of the quarter and starting from a far more elevated level, despite the fact that we've already had 2 rate cuts. That's well worth noting, because it really does suggest there is a little bit of a shortage of either bank reserves or dollars out there, probably a combination of the two. But it certainly is going to start playing out in terms of the way that asset markets play and in terms of the way that people position themselves, above all in the banking sector, for those year-end funding pressures. It also means that margined products, i.e. pretty much every derivative that you can care to think of, have a higher funding cost, and that in itself tends to dampen activity. And secondly, it also tends to lend a little bit more to volatility. So we shall have to keep a close eye on this, how this plays out through the quarter. My fourth chart today is about volatility. And one can see that we've got the green line there, which is the US Treasury market volatility, the MOVE index. At the bottom, we've got the VIX index, the S&P 500. We have been somewhat more elevated this year, though it's hardly been tragic, one would have to say. But the risk would seem to be that that is probably not going to actually come back towards the levels that we saw in the middle of September. My fifth chart, I think, is another important one, because we look at US rate expectations and see them as a driver of the S&P 500. Well, just have a look at this one. This is the US WTI oil future against the S&P 500 E-mini. And what we can see is basically the S&P 500 ignored the down move after the Saudi oil attacks, but was brought down with a fairly big bump. And we're going to have to keep a very close eye on oil prices as we go through the quarter, because that is going to be definitely something which drives market expectations and will also drive the S&P 500. And those are the thoughts for this week.